Okay, hello everybody. We're going to get started. My name is Pete Pinedo, and I do community outreach and business development here at First Northern Credit Union. So welcome to Solving the Mystery of Credit Reports. We do these financial wellness webinars not only for our members, but the community at large. And one of our core missions here is financial education at the credit union. And although I'm still working remotely half of my time, I'm usually working out of the Evanston branch. For those who don't know, we're the credit union for Northwestern University and Northwestern Medicine, and we are the financial education partner for the city of Evanston, which this tonight this webinar is for. And so with that being said, we have plenty to cover today, so let's get right into it. And if you can't hear me clearly, please let me know. If you have any questions, please ask them in the chat area. Usually when I do these presentations, and I'm doing this by myself, but tonight usually I have a partner who answers questions in the chat while I do the presentation. But I will get to all of them. They all come to me directly. So I will address them hopefully as I go along, but otherwise definitely at the end of the session, okay? And please don't hesitate to ask anything. It only comes to me, and the only silly question is the one not asked, right? So I'm sure most of you have the basics of credit reports, but we're going to dive just a little bit under the hood for you regarding how the credit reports are used. So I think I'm going to attempt to go. Let me see. I'm technically challenged sometimes. So let me see. Where am I? Solving the mystery of the credit reports. Okay, I'm going to go to the first slide. What's the first slide? The credit bureaus. Okay. And with all the webinars, we hope that a lot of the stuff is basic, but we hope that you walk away with at least a little bit more knowledge than you arrived with, okay? 3 credit bureaus, the major ones, CRAs, the credit reporting agencies. These are the companies that compile and maintain the credit reports. So it's Equifax, Experian, and TransUnion. They're used in the U.S. Okay, those are the major ones. The credit bureaus are required by the Fair Credit Reporting Act to compile accurate information that is sent to them from creditors and to provide credit reports to businesses that pay them money for that information. Theoretically, all 3 of your reports should be the same, but they aren't, because although they get the same information from the reporting creditors, they have slightly different algorithms that compile the score. And by the way, creditors don't always report their respective information to all 3 credit bureaus. So it depends on the respective company's policies and protocols, okay? So the obvious creditors that look at your credit report are the banks and retail stores, mortgage companies, and they take a look at the credit and what's inside the credit report. The devil is inside the details, right? And that's really what they're looking at when they're deciding whether or not to approve your application for a loan or a credit card or a line of credit, etc., all that good stuff. And then deciding on what interest rate, of course, to charge once you are approved for that specific loan, interest rates being the cost of borrowing that money. But there are other not so obvious creditors as well that are also looking at these scores, like insurance companies, building management companies, employers. So yes, the credit score can come into play when looking for a job. Potential employers are checking credit these days, or they have been for quite a while. Utility companies, landlords, they're checking this stuff. Bottom line here is good credit puts you in a position where you will be eligible for the best interest rates on all the monies borrowed. And it shows creditors that you are financially responsible. Okay, next slide. The Fair Credit Reporting Act. So this is the law it's designed to promote accuracy, fairness, and the privacy of all the information in the files of every consumer reporting agency. And any violation should be reported to the Consumer Financial Protection Bureau, since that is the governing body that regulates the credit bureaus. On page, if you haven't, and I don't think I had mentioned it, there's handouts that you can download. The one being just the general handout, and the other one that you can download is the credit rebuilding program that we worked out with the city of Evanston and our partner, our vetted partner, Balance, and we're going to get into that later in the presentation. So, and I bring that up because information is the contact information is on that handout. I think it's probably on the first page, and it gives you detailed information about the FCRA and the rest of the contact information. These are just bullet points, and I'm going to make a PDF file of this PowerPoint presentation as a follow-up over the next couple of days, so you don't have to write down all your notes. You can, but you just know that you're going to get these bullet points, okay? And so before the presentation ends, the handout for this particular webinar, just so you know, it's a very efficient. We do several webinars, and the handout for this one is a really efficient handout with all the information that it's a wealth of information on this particular handout that you're going to get or that you download. Okay, it's awesome. So just keep that on file somewhere. Okay. All right. Next slide. Obtain your credit report. Obtain your report. So one of the points here, or one of the points I should say on the previous slide, is that you personally have access to your credit report. You should check out the report for accuracy at least once a year, and reports can be obtained by ordering them through the bureaus or for free, which we recommend through annualcreditreport.com. That's annualcreditreport.com, and that is also on the handout on the first page. And it's a legitimate website that's actually jointly operated by Equifax and Experian and TransUnion. When you do request these are free, and we suggest that you stagger the requests every 4 months, because you get one free report from each one of the credit bureaus. So this way you'll have, even though they're not exactly the same, you'll have an idea of what's going on with your credit report throughout the entire year if you do it this way. Let's say today you request a free one from Experian through annualcreditreport.com. Then 4 months from now, request one from Equifax. And then 4 months after that, request one from TransUnion. This way you can always keep an eye out, see if there's any changes, any negative things that come up. And there's mistakes that happen a lot of times, and there's erroneous entries that could be seen on those, and you want to dispute those right away. And you can dispute any of these things on your credit report. By the way, my personal so I've gotten credit reports from annualcreditreport.com and creditkarma.com, and it's also free. What Annual Credit Report does not give is the actual credit score. It gives you all the information inside the report. It just doesn't give you your score. Credit Karma does that. Plus, they do give you the trade lines and all the information. It gives you the credit report as well, okay? So I like that. It's free. You just got to be careful because, you know, they just try to sell you stuff, you know? It's almost predatory-like, in my opinion, but I guess what isn't predatory these days? But it actually gives you your score along with the trade line, so that's why I like it. Annual credit report isn't trying to sell you a bunch of stuff while you're going through your report, okay? And I know that I've mentioned it, but I want to reiterate that all three bureaus don't necessarily contain the exact same information. We're going to get into the scoring model that they use, which is FICO, but even though they all use the same model, they're going to be slightly different, as I mentioned before, because maybe not every creditor has reported everything to all the credit bureaus, okay? And as a creditor, sometimes the creditor will use all three bureaus. Sometimes they'll only use one. I think over at First Northern, I'm not an underwriter or an FSA, but I'm pretty sure they use TransUnion. So there's other creditors that use, maybe they'll take an average of all three. Maybe they'll use their own proprietary credit score model that isn't FICO. But most creditors do use the FICO and these three bureaus, okay? All right, next slide. The sections of the report. So the credit score is a mathematical assessment of the likelihood that you will repay what you borrow, and it's based on the information inside the credit reports, which tracks all your credit-related activity and the different types of credit, your retail cards, your personal loans, and car loans, and mortgages, and lines of credit, et cetera, all that stuff. And for each account, your report shows who it's with, the payment history, the initial amount you borrowed for the loans, the credit limit you have on your revolving stuff, and the current amount that is owed, and when it was open. So you also, the report also shows public records, public accounts like judgments or any credit-related legal activities like foreclosures or bankruptcies, any of that stuff. And it shows who requested, who's pulled the report as well. So it's got all that stuff. So all the sections are the same in each one of the credit reporting bureaus, but the information might not be the same, okay? Next slide. The trade line. So the payment history section under each creditor and the creditor itself is referred to as a trade line. It's just nomenclature. That's what they use. They call them trade lines. So any credit account you have is called a trade line. And this is where you want to pay the most attention under each one of these trade lines, where you can find, well, you will find most of, if errors occur, that's where you're going to find it. Any ID theft stuff going on, something that seems off, something that seems weird, you're going to find it usually, or any mistakes that are made, you're going to find it under these trade lines. These bullet points show exactly what appears under each creditor, under each trade line. So it's kind of the meat of everything. Okay, next slide. So what makes up the score? FICO, as I mentioned. The FICO score is the most common used model. There are several other models, but the FICO score is the most common one that's used. It's the Fair Isaac Corporation, and this and the range is between 300 and 850. You've got something above 800, you're awesome. You're the best of the best. And we have a different webinar that gets in all of the different other models. I'll mention a few towards the end, but again, the FICO score is the one that's mostly used by these three main credit bureaus. And the credit scoring pie here represents the different weighted categories that go into making up the credit score itself. Again, the credit score is just a metric that measures how good you are at borrowing money. How much your credit, it measures how much your credit worthiness is. It sums up the likelihood that you will repay what you borrow. And there are a variety of factors which we will get into right now. And these are different measures. There's different algorithms, but these factors are calculated by using the information that's inside the credit report itself. So it's important for you personally to know what is inside the reports. And I reiterate that incorrect information appears all the time. So again, you want to have access to those credit reports throughout the year to correct any possible wrong information, I guess. Okay. And so anything more general I want to say before we hit this. So in general, most scores will fall in between 600 and 750. And don't quote me on this, but I think probably most mortgage lenders require at least a 620 or higher. I'm not an underwriter, so I don't know exactly. And I know that there's plenty of consideration, at least with the credit union. So there, I just plugged the credit union for First Northern. And it's important, and I know that you know this, but it's a simple, an example I like to use, a $200,000 mortgage, okay? If you have a credit score, 100 point difference, so a 100-point difference between somebody who has a 740 and a 640 it could cost you over like a 30-year loan. It could cost you like up to like $40,000. I did the calculations before, like 40 grand. So that's a lot of money. So, all right, let's get into this, the pie chart. So the highest percentage is 35%, which makes it represents your on-time payments. So making your payments on time boosts your score. And conversely, if you make late payments, your score will take a hit. That's common sense, right? Collection accounts, legal actions, that's going to have a negative impact. Late payments, the payments that are on time, I should say, means no longer than 30 days after the due date. So you get the billing comes out, you get your statement, you have 30 days to pay that. And that's considered payment on time. Payments that are, let's say, 120 days late, it's going to have a more negative consequence than payments that are, say, only 60 days late, which are more a negative, which is more of a negative consequence that for payments that are only 30 days late. Okay, so 35% of the total score pie takes into account these on-time or not on-time payment history. The next percentage, 30%, that's called, this is what you owe, the amounts owed, makes up 30% of your scoring model. It utilizes what's called a ratio, a credit utilization ratio, and it's derived by taking the total amount of your current debt, and I'm just talking about revolving credit right now, okay? Just talking about revolving credit comes into this credit utilization ratio. Take the total amount of that current debt that is shown on your credit report at the time, and they divide that number by the total amount of available credit that you have. And both of these numbers are in the credit report. And this fraction, again, credit utilization is also called your debt to credit ratio. Quick example, if you have a total revolving credit limit of $10,000, let's say, on 3 different cards, and you have a total of $5,000 in debt right now at this moment, the amounts that you owe these credit card companies right now, you would have a 50% debt to credit ratio. If you have 7,500, that's a 75% debt to credit ratio. 75 divided by 100, okay? And the FICO scoring model says, hey, the less outstanding amount of debt that you have, the better. So it's not a good thing to have the total amount of your outstanding debt that gets closer and closer to that total available amount of credit, okay? The lower your debt to ratio, the better. Again, it's looked at by the scoring model that says, hey, this guy, this gal is being really responsible with their credit cards, so let's give him or her a boost in total credit score. Carrying large balances on these, again, we're just talking about revolving debt, particularly if those balances are close to the credit limit, it will lower your score. The lower the debt balance compared to the total amount of available revolving credit, the more positive effects that will have on your credit score. And the ideal credit utilization ratio is 30%. So the 30% amounts owed, and 30% is where you should be, that and lower with that total balance, okay? And again, I'm going to reiterate, it's just the revolving credit that you need to pay attention to that comes into this credit utilization ratio. And for those who don't know, examples of revolving credit would be, yes, your credit cards, but they also include your personal lines of credit, your home equity lines of credit, those HELOCs they call them, home equity line of credit. That's also part of your revolving credit, okay? And to be even more precise, so I ram this even further, revolving credit accounts let you repeatedly borrow money up to a set limit and then repay it back over time. That's what credit cards are, right? Now, installment credit are set amounts of borrowed money like an auto loan or a student loan or a mortgage, okay? That's installment stuff. Okay, so this, let's go on. The next piece of the pie, 15%. It takes into account the length of your credit history. The longer you have had your accounts, the better. And this length is measured as an average across all the open trade lines that you have on your credit report at the time. So it's only the open and active trade lines that will factor into this specific average, okay? So it's a good idea not to close out the oldest open, good, revolving line accounts that you have with creditors. So if you are really using only one specific card, let's just say you have a few cards, you might be thinking of closing the other 2 cards. I suggest, I'm throwing it out there, that maybe you might want to keep those other credit cards open as well, because it actually helps in 2 ways. It keeps the denominator higher in that debt to credit ratio, which is, again, the total available credit, but it also extends the length of the credit history. And so now you'll probably have, like I do, I have 3 credit cards. I really mainly only use one. The other 2, one of them I put my Amazon Prime, the charge. I think I just raised that, by the way. It was $12.99. I think they just juiced it up to $14.99, just like this past month. So I have just one credit card I use to pay my Amazon, and I use the other credit card to pay my car insurance. Yeah. So I use those credit cards just to charge just something small. Well, the insurance isn't all that small, but just one charge a month just to keep them open. Okay. So I think that's all I have to say about that. So the length of your credit history component is the 15% of the 100% credit score pie. And the next piece is the new credit that makes up, it's 10% of your credit score. And this factor looks at the number and proportion of recently opened accounts and the number of hard inquiries, or the hard pulls that they call it. And the question is always asked. Everybody always asks: is this a hard pull? Is this a soft pull? It's a constant question. So a hard pull is when a lender with whom you've applied for credit with reviews your credit as part of their decision-making process. So you physically fill out an application for a credit card or an auto loan, let's say. That's a hard pull. And it's only the hard pull inquiries that come into this 10% part of the equation. A soft pull inquiry is when, let's say, you personally check out your own credit, or when a credit card company checks your credit. And I'm sure you've gotten these mailings for pre-approval stuff. So credit card companies, they look at your credit and they want to send you these pre-approval things, these offers that they mail to you. Those are soft inquiries. That's a soft inquiry. Your current credit card company, they'll take a peek at your report every once in a while as an ongoing policy that their own credit card has. That's their policy. So that's another soft inquiry. Soft inquiries are not factored into this 10% factor. Now, although too many hard inquiries on your report will lower your credit score, there are two financial instruments that are looked upon slightly different, and those are mortgages and auto loan inquiries. If these inquiries occur within a 45-day period, they are considered just one hard pull, just one hard inquiring for the scoring purposes. The scoring model creators, they understand that applying for multiple loans so you can compare your options and offers, it's a sign of savvy behavior. So be savvy. It's not a sign of risky behavior, okay? A sign of risky behavior is a constant search for more and more credit cards and filling out applications because you get these 0% credit card offers and stuff. So you're out there applying for everything. You're trying to, push one balance to a next, which is a bad thing to do, and we're going to get into that as well. I'll just say it now. The people get really concerned about the hard inquiry stuff. Now, if you already have solid credit, the hard pull versus soft pull, the hard pull here, it's kind of almost insignificant, okay? In the overall 100% credit scoring pie, okay? It's only 10%. You have a solid score already. Don't be too concerned about the hard pull stuff, okay? And it's, if you take the tiny little slight hit, it's going to be for a short period of time anyway, okay? So don't let it concern you too much. And the last piece of this pie is the types of credit, which is another 10%, and having different types of accounts with revolving and with installment credit, it's looked upon as a positive. So a mix of, let's say, a mortgage and a student loan and an auto loan, that's a plus in the scoring model. Not necessarily all at the same time, but the scoring model looks at the different types of accounts. The scoring model says something like this person can handle all kinds of credit, debt, curveballs that are thrown his or her way. So a mix is good. That's awesome. Thumbs up. Okay, next slide. So we're done with that scoring model pie. There you go. That's the meat. Improve your score. So the answers are pretty much in the scoring pie that we just went over. So the low scores can be improved over time with persistent effort. I say it because I've been there. And the bullet points here just touches on them, really doing things we actually just covered. And I strongly recommend for anybody who really needs to rebuild their credit, if you are in that situation, please email me. We bring in people all the time at the credit union. We put you in front of one of our financial services advisors, not to sell you anything, but to go over your credit report. And we actually do have, I think I mentioned it before, we have a special credit rebuilding program at First Northern. And it's basically a savings program. I'll explain that in a bit. And we have a credit rebuilding program with our partner Balance at the same time. And Balance is the company that helps us put these presentations together. And I am pretty passionate about this stuff because, again, I've been in deep trouble with the credit cards myself. So always pay on time. We know that it's not always possible because life is filled with curveballs, but you always want to pay on time because your history makes up, the payment history makes up the largest chunk of that credit score pie, right? So making payments on time is extremely important. Personally, I make an extra effort to pay my balance in full at the end of every month because it drives me crazy now to think about paying, the 15% or the 20% interest that they want to charge me on my balance. It drives me insane. And so I do my best, and I do make the full payment on those balances every month. But the only reason why I'm able to do that now is to pay all those the balances is because I spent probably about 2 years making extra payments every month to pay down the high balances that I had on those credit cards. So I did it. It's instead of buying the daily cup of coffee over at Starbucks, and I don't want you to go to Starbucks. I want you to go to your local coffee shop if you're going to do that. But people paying $5 a cup of coffee every day, it's $150 at the end of the month. Hey man, I think about taking that $150 and pay down some debt instead. You'll thank me after you lose all those balances on those credit cards, man. So you want to avoid, the bullet point here, you want to avoid at all costs taking out additional debt, especially if you're in a situation where you're having trouble paying the current debt. Again, as I mentioned, getting those promo pieces in the mail where you're paying off, you can transfer monies at a 0% rate for a while, and so from those credit, those new promos, and it kind of kicks the can down the road for most people, and because I did that, it kind of kicked the can down a little bit, and so at one point I decided that I need to just handle the situation. I need to bear down and brass tacks and get it done instead of just kicking the can down the road. Okay, so I think that's what else do I want to cover on this? And just other points that I have. You want to remember to check your credit report throughout the year. That's another point. I'm going to reiterate that. Annualcreditreport.com. keep your old accounts open, and if you have a positive history with them, a long credit history with the same accounts, it indicates stability. You want to limit those balance transfers that I just mentioned. It's usually a go-to for a lot of people who don't want to address the underlying financial problems immediately, but it's tricky, so you want to be careful with that. Avoid excess credit applications, like we mentioned. Even though, again, it's only 10% of the total pie, but if you don't have solid credit already, it's not so good. And be patient. So it may feel like the credit mistakes that you've made can haunt you forever, but your payment history from the past 2 years, let's say, is more important than what happened before that. Again, you have the power of time in your favor, and the most negative information is removed from your report after 7 years. So, all right, now I'm going to go to the next slide. How long will it stay? Okay, yeah, I just mentioned it. Okay, so the positive information remains on the report indefinitely if it stays open, and that's good. The negative stuff, the negative information will come off after a specific time frame, and it's usually 7 years. And remember, the negative information, and it impacts your FICO score, it impacts it less and less as the debt gets older and older. And for that reason, your credit is never ruined. This is my positive thoughts for you. It's never ruined. You can always have the opportunity to improve your score. And the only exception to this 7-year rule is Chapter 7. It stays on for 10 years. Next slide. And I'm going to go on hold for a second. I need to drink some water. Thanks. Thank you. I'm back. I needed that. So, correct, inaccuracies. You personally can correct inaccuracies. Again, that's why it's important to always look at those credit reports. And the fastest way, usually, to resolve any of those disputes is to visit the website of the respective credit bureau, reporting the incorrect information. Again, it's on the handout that you'll download, or I will send you in the next couple of days. And any disputes that you send to them, if you send it via email, you want to do it certified. That's what I do with all my taxes too. And on the report itself, at the last bullet point here, you can always have a statement that's put on the actual credit report itself. You're allowed to do that. Beware credit repair. So they're pretty much talking about consolidation companies right now. I know a lot of these places, they sound attractive, but bottom line is that these companies will charge you a lot of money that you can take simple actions with yourself. And we suggest, or I suggest, that the first step is to contact me. Send me an email. If you're in a situation, send me an email, or contact directly the Balance website. We're going to visit that in a second, or I'm going to show it to you. Balance provides all kinds of information, not just credit repair, and you don't have to create a profile over at Balance like every other website on the planet. But you can have access to podcasts and videos and written materials all for free, and you can get on the phone with a counselor for free. And this slide just wants you to make sure the buyer beware regarding these credit repair companies. And remember that despite any claims that maybe a credit repair company will say, they have no ability whatsoever to remove accurate information from your credit report. And if they claim that they can, they're not being honest with you, okay? So they're just using your information for whatever reasons, okay? So talk to us first, okay? Next slide. Identity theft. That's hard for me to say. Identity theft. It's a nightmare. So always keep your eye on your report. We have a whole webinar on ID theft, and I have a few experts outside of our company that I think I will include on one of these presentations that we give when we do the ID theft, because they are indeed experts and they can get into the weeds of this kind of stuff. So just be very careful. I remember years ago, I was in college and I got a call from a hotel in Wisconsin. I went to Northern. I got a call saying, "Hey, you owe us $1,200. I'm like, "What?" So turns out this guy knew somebody at the DMV, pulled up my information, matched his information, got his picture taken, and he had an ID. He had a state ID, or was it the driver's license? Either one. He had his picture with my information. I was able to resolve it real quick because I started making phone calls to the calls that they were making from the hotel, and I found the guy. Yeah, we have big, terrible stories of ID theft. So it's important to keep an eye out for that. Don't leave your stuff lying around anywhere. Shred everything. You know, sometimes I tear up every bill that I have. I tear it up with each letter of my name, and I tear it right at that spot, and tear it even more before I throw it out. We have there's a couple of days, and I know the city of Evanston and throughout the city of Chicago too. They have these shredding events, maybe twice a year at least, I think, where people just come and you shred that stuff. So don't leave your stuff lying around. I had, what was the other one? I had someone, I mentioned Amazon. I had someone tap into my Amazon account and mailed me the item that they ordered. It was bizarre because I never ordered it. And it was something that I would never have ordered. I don't remember what it was, but they sent it to me. I don't know if it was like maybe a trial run for something that was more nefarious or something, but people are crazy. People are, especially these days. So just be aware of all this stuff that's going on. Next slide. Damage control. So these are specific steps that you should take if you do find yourself a victim of ID theft. And you definitely want to file a police report. Contact the credit bureaus and all your creditors. Let them know that you want to put a note, and you want to put a note on the credit report as well, okay? Which we've already mentioned. Next slide. Other types of reports. So, yeah, I think it's on page 6 of the handout that lists other information, just like check systems here. This is what banks and credit unions use when somebody wants to open up a checking account. This information shows if somebody was overdrawn and then they closed their account without making good on it. They were overdrawn and they bounced checks. That's the check system. The National Tenant Network is used by landlords. It reports evictions and non-payment issues. And I'm not really familiar with it. But outside of the well-known FICO model that we just went through, there are a bunch of different other models. But I'm just going to throw out a couple of them at you. There's what they call the Vantage score, which was indeed created by Equifax, Experian, and TransUnion back about 15 years ago, I think. called just the Vantage score, and it's an alternative to the FICO score. And it has numbers. It's numerical, but it also has a letter grade as well. But the model looks at the same data that FICO does, right? So paying on time, keeping credit balances low, avoiding new credit obligations, especially if you're about to get a mortgage, and the mortgage broker will let you know that too. So will your real estate agent. You don't want to be taking on new credit once you get pre-approved and all that stuff. And I think that this Vantage scoring model, it allows scores to be generated for those with credit histories that are shorter than 6 months. I think that's the thing. The FICO, it's over 6 months, and so there's other modules that focus on, let's say, like the likelihood that someone will file bankruptcy given their current financial situation. So more weight is put on those factors than any other weighted factors. And there are internal scores that are utilized by companies that it's just their own internal scoring models, proprietary. But generally, look, if you make your payments on time, you keep your balances low, and you make it a practice of the solid good habits that we mentioned, everything that makes a good FICO score will be a good score under any of these other models, okay? All right, next slide. Final thought. Do I have a final thought? Well, I think my only final thought was, obviously we all want excellent credit and excellent credit history, but we know life throws us a bunch of curveballs at us, and it usually happens all at once. But just know that you can always repair whatever damage that there has been done, okay? So never give up hope. And as I mentioned, we have our own credit rebuilding program, and it works like this. It's kind of cool. We put, I think, like $1,500 into an account for you that you pay monthly towards, okay? We call it a credit sense loan, okay? So now after 6 months of on-time payments, we give you an opportunity for a credit sense visa, right? So so you make these on-time payments, and after a year, when it's all paid off, the money is all yours. So now it turns into it's a savings account. So it's a credit rebuilding and a savings account, because what happens along the way, you just rebuilt your credit, because every month that you made those payments on time, we report those payments to the credit bureaus as on-time payments. So it starts to rebuild your credit score. And plus, we've got other programs with balance that I mentioned. If you sign up, and in the handout, under the handout, I put the Evanston certificate. Yeah, the City of Evanston certificate model. So it's like nine different videos that you have to watch. Okay, so if you sign up for that, you get the certificate through balance. You watch these videos. Each one is like, I don't know, 10, maybe 15 minutes tops. I think they're like between 5 and 10 minutes, actually. So you take a look at these 9 videos, and you get a certificate, and it's all pretty much basic common sense stuff, right? And then once you do that, we knock off, instead of the 6 months that it takes to rebuild your credit, and you get that visa. You can apply for that Visa credit card. We knock 3 months off that, so you're eligible after just 3 months instead of 6 months. So spend time to spend an hour going through these videos. We knock 3 months off for you. So easy peasy stuff. And I'm going to check. Let me see. I think. How quickly do changes in FICO-related changes take effect on your FICO score? I think you're probably asking about this particular program. I can't say because it depends on. So what I think you're asking is if you have a score of 600, how much of an increase point-wise would it be increased after you have taken the Credit Sense program? I don't know. I can't say. I know. In fact, I talked to a couple FSAs about this not too long ago, and it all depends on the specific person and the specific situation. It really comes down to that. But regardless, you will have on your credit report, you will have these on-time payments that we will report as on time. So it's going to have a positive effect regardless. How much in total points, I don't know. I can't say. Nobody can. I mean, I could put you in touch with an FSA and see what they say, but I don't think they can say anything specific either. I hope that answers the question somewhat. Okay, and that's it. Let me see. Let me just check a couple of. Okay, no, we answered that. But then you that 12 that survey your score. Anytime you pay off full debt, if you pay off the full score, or I'm sorry, the full balance, that is a positive effect on your credit score. Anytime you pay down that debt, and then you keep that card open, if you're talking about a card, so you'll take maybe a slight possible hit initially if you're looking for just filling out those applications for like 3 of those credit card applications. You take a slight hit, right? But overall, if you're just trying to buy time, you get like 0% for 12 months, and you plan on paying that balance off within those 12 months, interest free. That's awesome. And you will, and your credit score will be positively affected by that. I hope that answers that question. And I'll have, if there's any more questions, I'll leave this open for another minute. But that's pretty much everything. I want to. Let me see if I can. I want to see if you guys can see this. Share this. Let me see. City of Evanston. Okay. So hopefully you guys can see it. Let me see. Oh yeah, you guys can see this. Okay, so this is where you want to go, evanston.balancepro.org. Again, it will be in the email that I send you, along with the handout that I send you. And this is where you come down. This is where our different programs are. You can sign up. But this is where you would go, evanstonbalancepro.org. When you sign up for the module situation, you're going to have to go through the program, and I have it all written out in that explanation, the PDF explanation. You have to go through the program. At this point, you would have to create a file. Like I said before, you don't have to create a profile. And when you come here, you don't, unless you get involved in the program. If you sign up for the program, the CERT program, the certification program, you would have to create a profile, okay? evanstonbalancepro.org. So this is where you would come, okay? And let me see. Is there any other questions? But what if you don't pay it all off, but a good portion, and doesn't improve your score the next month? No, it takes at least a few months. How quickly does FICO changes? It usually takes a few months, from what I understand. and I get this information from the FSAs or branch managers that I talk to, because I don't do the financial services end of things. But if there's any more specific questions on your specific situation, the ones I just answered kind of seem more specific, please email me. When I send the follow-up email me. Don't be afraid to ask anything. And if you're in Evanston, I usually set people up who contact me. I usually set them up with our branch manager, even though any of the FSAs over there can take care of you, okay? On that note, my last note is I appreciate you all coming out. And remember that you don't have to stay behind the 8 ball if you are in trouble financially. You can always get your way out, and but sometimes we need a little help. So ask away if you need any help whatsoever, okay? And I will follow up. I appreciate everybody spending time with me this evening. I wish you the best health, wealth, and opportunity, and all that stuff. So, all right, have a great evening. Bye-bye.